Hi, I'm Debra Brennan-Tagg, President of Brennan Financial Services. Welcome to the market review for the fourth quarter of 2018, and thank you very much for joining us. You might look at your calendar and wonder what took us so long to get our fourth quarter market report out, but after the market downturn in December, we decided to watch all the way through January before releasing it, and boy, are we glad that we did. We really saw a nice rebound, and we'll go over all that with you over the next few minutes. Our themes this quarter are up and to the right, no news is actually bad news, and our evergreen theme, diversification. Let's get started. The red arrows on the quarterly market summary quickly tell the story of the fourth quarter. Stocks took a beating. U.S., developed international, emerging markets, and global real estate all lost significant ground in a hurry. Just like everything worked well in 2017, almost nothing worked well in the fourth quarter. And just like we knew that all the positive momentum of 2017 couldn't last forever, the same is true of the stock market in the fourth quarter. To make sure that we have the proper perspective about the fourth quarter, let's back up and look at the performance for the same indices over a much longer cycle, which is really what investors should be thinking about. We turn to the long-term market summary, and we have the ugly one-year numbers across the top. But even with those one-year losses baked in, take a look at the five-year numbers. The U.S. stock market leads the pack with a return just under 8%, which is really a nice result for a long-term investor. The international numbers are obviously a disappointment over that time period, and we'll dive into those just a little bit later. While the 10-year numbers look solid across the board, I will remind you that 10 years ago, these numbers started at December 31st, 2008, right in the middle of the financial crisis, which means that the huge returns that we saw in 2009 are included here, and may skew the perception a little bit of the long-term returns that investors should expect from the assets listed here. Now let's move from the very long-term to very short-term in our perspective. This is a chart that shows the S&P 500 return since January 1st of 2018. We see the dip in February, which you may have even forgotten about, the solid march up and to the right over the summer, and then the weakness of the fourth quarter. The most interesting part of this chart to me is the enormous and very skinny V on the right side that shows the complete wipeout in December, followed by a massive rebound in January. An interesting note, if you need a piece of trivia for your next cocktail party, is that the S&P 500 lost 9% in total return in December of last year, and that ranked it in the bottom 2% of monthly returns over the last 30 years. It then turned around and gained 8% total return in January of this year, and that performance ranks it in the top 4% of monthly returns over the last 30 years. So what happened in the fourth quarter and then seemingly happened in January? We'll continue with our view over the past year. The headlines from January through September are mostly neutral or positive. The one big exception is that US and China tariffs hit American-made products from chips to cars. While the market did continue up and to the right after this, the uncertainty around how the China trade war will affect the economy was, and still is, a heavy burden on companies, their bottom lines, and their profit. Then the perfect storm of uncertainty started swirling as the Fed raised rates again and let the market know to expect another one. The Eurozone started showing weakness, a Democratic wave got elected to Congress, and home sales dropped, spurring recessionary concerns. Pile on a huge government shutdown, and another Fed interest rate hike, and voila, steep but temporary losses. No news is in fact bad news to a stock market, as uncertainty leads investors to worry. So now we return to the question, what happened in January? We don't have any more clarity about China, so that's still a risk to the market. The Fed, however, provided some calming language in January about the path of interest rates this year, and they indicated that they may not continue to march rates upwards. The government shutdown has ended for now, and economic indicators, especially those about job creation, remain very, very solid. I do want you to pay attention to the chart in the upper right-hand corner that gives long-term investors the perspective of the historical returns of the world index since the year 2000. Even though December felt ugly to absolutely all of us, it's a small setback over a long market cycle that has moved up and to the right. Let's take a look at the fourth quarter returns by asset class to see just how ugly the fourth quarter was, not just here, but worldwide. In a swift downturn like we had in December, diversification can't do enough of a job to compensate for all of the losses that we saw, for example, in the Russell 2000. But bonds in the end did exactly what they were supposed to do, which was to serve as part of the portfolio that just didn't lose, and in fact turned in a positive return when nothing else could. As we look at U.S. stocks, we probably don't need to beat up their performance anymore for the fourth quarter, but it is a good reminder that the reason that we invest in the U.S. stock market is for the possibility of returns like we see over the last 3 and 5 years. We have a slightly different story with the international developed stocks. We still saw steep losses over the fourth quarter and over 1 year, but over the 3 and 5 year periods, investors really were not rewarded. Last year, we had a huge surge in the dollar. If this reverses this year, then we might actually see international assets perform better. Emerging market stocks had 1 year numbers similar to international developed stocks, so they were terrible. But the 3 year numbers for value, large cap, and growth for emerging market far surpass those of international developed. As an example, if we look at international developed in the value arena, the 3 year return is 3.36. If we look at emerging market in the value arena, the 3 year return is 9.52. This means that investors that can stand the volatility of emerging market stocks have definitely been rewarded over that time. We do hold real estate in some of our portfolios, so we'll touch on this briefly. Interest rates and general uncertainty about the economy have challenged publicly traded REITs over the past 3 years. We really see real estate as an important diversifier and still favor investing in private REITs versus public REITs, which are shown here. We don't hold commodities in our portfolios, and looking at historical returns, you can probably see why. One thing I do want to call your attention to is gold. Gold is a fear and greed asset, and when there's fear in the market and the economy, we expect to see gold go up in value. Sure enough, gold was up 6.59%. When we look at fixed income, we're really looking at bonds, and this slide can be a little bit busy, but if we look at the return numbers, none of them are knock your socks off kind of return numbers. They're all fairly muted. At this point in time, what we expect of bonds is to provide income, which is one of their primary purposes, and honestly, to just not be stocks. We want bonds to be able to reduce the risk in our portfolios and give us a nice balance so that clients can stay invested over a long time period. We also have to understand that bonds don't have great return potential over the next few years. That doesn't mean they should be removed from portfolios. We just have to adjust our expectations for them. We can see the impact of diversification clearly here in the mountain chart and in the returns. So both the 75-25 portfolio, which is 75% stock and 25% bonds, and the 50-50 portfolio, 50% stock and 50% bonds, are moving in a healthy up and to the right direction. If we look at the return numbers over the past 5 years, we see some really interesting numbers. The 75-25 portfolio had a return of 3.86%, and the 50-50 portfolio had a return of only 2.82%. Probably a little lower than most investors would expect. That's really because of the fourth quarter return numbers. The January returns may get some of this back on track, but it is important for long-term investors to understand these performance trends. Thank you very much for joining us. We are a holistic practice focused on financial planning and investment management. In fact, we design portfolios to serve the financial plan, managing both our clients' growth goals and their risk budget so that they can stay invested in up and down market cycles. If you have any questions for us, or if you need help using your money to have the life you want, visit us at debrabrennantag.com or send us an email at teamdbt@brennanfinancialservices.com.